Everyone, and welcome to another LinkedIn Live with us. Today, we are talking about investing in fixed income investments, and I'm really excited to share about the guests that are joining us today. My name is Metha, for those of you who may be joining us for the first time, and I'll be the moderator for today's discussion. And along with me, I have Ankit. So, let me introduce him first. Ankit is my co-founder at WealthUp. He graduated from BITS Pilani and started working as an investment banker with Swiss Bank in New York. Um, his friends and family would often ask him a lot of questions about financial products and what's right for them and not. We both kind of identified that there is a need for guided financial planning, and that is what WealthUp is all about. Today, WealthUp is helping a lot of people find investing become more convenient, especially for working professionals, and guiding them towards financial independence. So, hi, Ankit, and welcome.
Hi, Mida. Hi, everyone. Thanks for joining. Lovely to be here and talking to you again.
Perfect. And our next guest, her name is Soumya. She's the co founder and chief business officer at TAP. She brings with her a wealth of experience from her time as a consultant in McKinsey and as a former co chair of BCIC Karnataka, a key think tank for the government of Karnataka. With a degree from IIM Ahmedabad, she combines strategic insight with a deep understanding of financial markets, driving TAP's mission to transform retail fixed income investments. So, Ankit and Soumya are the best people who are positioned to have this conversation today, which will majorly revolve around opportunities in fixed income and how this can fit in your investment portfolio. First off, Ankit, first question to you to start off with. If you
Yeah,
can just kind of,
Soumya is not on stage.
yeah, I will just bring her on. I just wanted to ask you the first question. The first question is that, for most people, they've only heard of FDs, right? So, when it comes to fixed income, if you can just talk to us a little bit about, sorry, Soumya's here. I'm just going to add her. Hi, Soumya.
Yeah, hi.
I was just asking Ankit that most people, when it comes to fixed income, have only heard about FDs. So I just want to hear from both of you, if you can, like, let's just start by unpacking what fixed income is, because I think to start with, a lot of people don't even understand what that is. So maybe, Soumya, you can, answer the question first, and then Ankit can um,
Sure.
add.
Sure. See, we are at when we at TAP talk about fixed income, we essentially cover a whole bunch of asset classes, not just FDs. FDs is definitely the safest and the most widely used fixed income product. But then beyond FDs, there are many more. For example, there are bonds, there are new age products like MSM REITs, which is fractional real estate. There is some component of digital gold with leasing returns that qualifies as fixed income as well. So there are a whole plethora of offerings which come under fixed income, and FD is definitely the beginning point. But as and when people start becoming more accustomed to the whole space, they keep graduating to slightly higher risky fixed income asset classes where they can diversify for slightly higher returns as well. I'll probably hand it over to Ankit to add to this.
No, I mean, you covered pretty well. So, yeah, I mean, FDs is something that people, just start with. And the thing is that they consider that it's risk free. Any amount of money that is going in FD with any bank, it's risk free, which is not the case. But yeah, FD is the first step of, and that is what something most people know about. And
Right.
yeah, so many new products that are coming up, and we'll be talking about a few of them that people should be made aware of. And after evaluating the risk and associated, the returns that can generate, there can be a number of opportunities, and a few of them that Soumya has already mentioned.
So, Soumya, given your experience of helping your users invest in fixed income, what are some of the changes that you've observed in India's fixed income markets, particularly in the last 3 to 5 years? Because, this is a very exciting space. A lot of things are changing. So, for those of us who are maybe new to this, if you can just walk us through, what are some key developments that have taken place?
Sure. I think I would classify there are two broad categories of developments that we have seen being in the space. One is obviously on the regulatory front. We are seeing many tailwinds coming in over there. So Notably, there was OBP regulations that came in about 2 years back, where SEBI called out that there is a new license which is going to be needed for anybody who's building an online platform for distributing listed securities, debt securities particularly. So there is an OBBP regulation that came in. Then SEBI also reduced the minimum ticket size of investment in bonds, which was earlier about 10 lakhs. That came down to 1 lakh, and now in July of 24, it was reduced to 10,000 rupees. So that was another big move. And then in November, there was also a liquidity window facility that came up, which is essentially focused on improving liquidity in the fixed income market, particularly bonds and listed securities. So these are some of the interesting regulatory developments that we have seen. The other category is mostly on the tech product platform play. So until maybe before, let's say 4 5 years, there were not too many players who were talking about fixed income or providing fixed income opportunities. But in the last 3 to 5 years, we've seen a surge of many platforms that have come up distributing products like asset leasing, invoice discounting, fractional real estate, bonds, digital FD, digital gold, and whatnot. So, a lot of action and opportunity being tapped into by both incumbents as well as new players by building in tech platforms, making these products accessible for retail.
Right. And where do you see this kind of going, right? Like any idea about what we can expect?
So, I think two things will happen. One is, as and when the space is catching on heat, regulators are definitely trying to understand what all is happening, the latest developments, and they are also learning with the platforms and the user behavior and coming up with more and more regulations to cover as much ground as they can. So that will continue happening. We'll probably see more iterations and revisions to whatever regulations already exist, plus probably some new regulations or guidelines might also come in, because even today not all products are directly governed by any of the regulators, right? So that might happen. This ideally would be hopefully positive for the investors and the space overall, especially when we talk about bonds. SEBI has been very vocally active in terms of deepening that market for retail. On the other hand, I also feel like there with an increasing number of players coming in the market, there are many problems which currently exist, which would get solved. Everything ranging from ease of discovery, education, and awareness. It's basically a category building exercise, similar to what similar to what we saw happening with stocks about 10 15 years ago. I think similar sort of effort in terms of building this category with the existing players will be seen in the next 5 to 7 years. So that will be very interesting. I think it'll fixed income will become more mainstream. Not just FDs, but a lot of other variety of products will start looking more prominently in the portfolio of users. So I think this is what we are going to be expecting in the next few years.
So, how do you think that will change the market itself, right? So, for example, like, yeah, now with all the mutual funds, Sahi hai, so many people getting into mutual funds, right? So we see like a surge of SIPs going towards mutual funds, etc. So now with better investor education, etc., do you feel like there will be more competition, more definitely more supply of money for sure, but will this change anything on the investor side? So, just to give an example, let's say there's an invoice discounting deal, and it typically takes maybe a day or two to fill up, but then do you see that there's so much competition that um, like I guess supply and demand both will see a surge?
Yeah, yeah. No, you're right in that sense. So, and it's interesting to see that this is not just because of what's happening within the fixed income space, but also getting affected by what's happening in other asset classes. So, for example, just like how we see the gold prices moving almost opposite to how the stock market moves, right? Similar sort of movement can be expected to be seen even in the fixed income space, and there is correction happening, long impending correction. We don't know for how long it will last, but whenever there is such expected correction to happen in the equities market, there is definitely a surge in demand for fixed income deals, and that's what we are actually seeing on the platform as well. So these macro factors definitely affect a lot, and inherently, I believe so. When we look at India's retail story from a disposable income or the earnings standpoint, it's on a higher trend, right? So people have more
Yeah,
income, they're earning more, the disposable income is higher, and therefore the need for better investment products is also higher. And
yeah,
naturally, what happens when you have more money is that you want to prioritize wealth preservation over taking risky bets to make higher returns. And that's where the role for fixed income will become even more mainstream, and people will start hunting for these deals which are better yielding than FDs, but
yeah.
more or less similar level of risks are involved. So I think this is what we will definitely see happening in the next few years.
I think that's really interesting also because we keep getting asked this question, ठीक है mutual fund कर लिया पर और क्या? And there's
Yeah,
this constant thing like what else do we invest in? And
correct.
after a point it's like okay, you have mutual fund, you have gold, and then there's real estate and those very typical traditional kind of asset classes that people understand. But then I think everyone is always looking for a trending
Yeah,
new thing to invest in. So I think that will be interesting and for us to answer to our clients as well. Yeah, right, like that's something new happening.
yeah.
So I think that will be very interesting. Ankit, want to hear from you, right? So talking about this, so many wealth managers will talk about this, and we've seen it ourselves that a lot of Indian investors have an equity bias in their portfolio. So from your interactions with your clients, what are some misconceptions do you see people have about fixed income, and why do you think so many people have this um, preference towards equity?
Sure, Veda. See, when it comes to retail mutual fund investments, over 90% of them are in equity mutual funds. Okay, I'm talking about the retail segment. And most of the people think that mutual funds means equity funds. I mean, they are the same thing. They don't even, many times, they don't even know that within mutual funds, there are other categories. And that's because that's how they are also sold. Like, so, okay, so like, traditionally, how is it that mutual funds have been introduced to us? Mostly mutual fund agents. Okay, and they tend to recommend equity funds, partly because that is where investor will be able to make more return of meaningfully more return than FDs, the 8% ballpark number, 7%, 8% that people make there. So that is what excites people. That is also easier for them to sell. Secondly, that is where they also make higher commission. So in the equity funds, the commission is relatively higher compared to debt mutual fund. So that is another reason for them to push equity mutual funds. But over here, when they are selling these equity mutual funds, they are only talking about the higher return that they can generate compared to bank FDs. They don't talk about risks. Partly risk is difficult to understand and quantify. Return, okay, we are making 10%, 12%, 20% return, whatever the number is, but risk is more difficult to quantify. So they completely, I mean, the generally risk is never covered. And this is something that investors don't understand. What is risk? And investing is all about balancing risk and return. Most people only focus on return without thinking about risk. And diversification is also something that is coming up, becoming trendy, but still people don't understand diversification. I have clients who when they start talking to me, they have
Sorry.
like, yeah, I have diversified my portfolio, and the diversification is they have invested in 20 different equity mutual funds. That's not diversification, right? So that is also something, again, education will be needed. And when coming to fixed income investing, as Soumya was pointing out, most people understand FDs is what fixed income is. They don't know that there are so many other avenues, particularly so okay, the people that we talk to, they're relatively younger, more tech savvy, and still they're not aware of other avenues that exist. Okay, so it's partly on us as well to educate them more. Okay, what these other opportunities are, and that is why we conduct so many sessions and try to have so many conversations. And we're talking about sort of a as Soumya pointed out earlier, like 10-15 years back, how it happened for equities, like shares, the equity market. That education needs to come in. The mutual fund sahi hai. There is a massive campaign. Okay, so something like that has to come, and that is how this will evolve.
So, okay, for those who are joining us, the education kind of starts here, right? Like that's why we're having this session. So, if you had to compare traditional debt funds to these new age funds that Soumya was sharing about, like how would you kind of explain it to a beginner?
Um, okay, so just debt fund comparison, right? Okay, so when it comes
Yeah,
to
so
debt,
debt investing options. So we're talking about fixed income.
so within fixed income. So FDs, though, people anyways know, कि भाई banks are there. People, consider that they're very safe, completely risk-free, which is not the case. Only up to 5 lakhs is safe, insured by the government. Anything over and above, it's not safe per se. If the bank fails, which we have seen, in past couple of years, few incidences, people have lost money, even in FDs. So when you see this small new bank is giving you 9%, 9.5% kind of return, let's put all the money there. That is not a good strategy. Okay. Now coming to debt mutual funds, the issue with most debt mutual fund is that they are very conservative. They invest in very safe assets. Okay, and that is why generally the return that we see over there is between 7.5 to 8.5% mostly. Okay. Now the thing is key, if you understand risk, there are opportunities, the ones that are coming up now, that offer slightly more risk, that have slightly more risk, but they more than compensate you in terms of the return. Okay, so if you're going something like slightly taking slightly more risk, getting into the region of 11%, 12% kind of return is something that you're taking with very minimal risk. Zero risk doesn't exist anywhere. Even the cash that you hold in your pocket, the literal cash that you have, that is also not zero risk. It can be stolen. Okay, and one thing that is definitely stealing your money every day is inflation, which we don't factor in, right? But there is no zero risk investment as such. Okay, so coming to these platforms and these new products that are coming, they are partly they are improving the access of retail investors on one side, but what we generally don't talk about, or it's not highlighted, is like they are also enabling the access on the supply side. There are so many people on the small and medium sized businesses that are not able to get access to credit. And in a way, these products with proper regulation and structuring and everything, they're bypassing those banks and middlemen, so that both the sides are getting connected. Of course regulation will be there, and it's not that just not a marketplace that anyone can start come on the platform and start selling it. There are filters that are in place, but with these, both the sides are getting access to each other, which didn't exist earlier. And of course both of them are getting compensated well. What is important is to understand the risk that is involved. I hope that answers the question, Nida.
Yeah. So, very importantly, sort of when we talk about any new asset type or class, we should talk about the risks that are involved. Since the partnership between WealthUp and TAP is primarily for invoice discounting right now, let's take a little bit of a deeper dive into invoice discounting. So, Soumya, if you can explain what this is, giving an example. So, like, what is invoice discounting?
Got it. So, see, invoice discounting as a product has been existing since a very long time now. It's a very common product that banks and NBFCs have been using to finance working capital for companies. So, just to simply understand invoice discounting, let's take an example of, let's say, ITC as a company, right? So, ITC would be sourcing a bunch of raw material from different vendors. Let's assume that they need to buy wheat for manufacturing their flour, right? Now, when they buy that wheat from the vendor, they will have to make payment to that vendor. And these are large invoices because they're buying in bulk. So let's assume that one invoice is a crore rupees. And this is also small in terms of what ITC would be dealing in, but just for ease of understanding, let's say that invoice is 1 crore in value. Now, this vendor would be a small SME or a business, a normal business, right? Probably doing a 10, 15, 20 crore turnover. This business, for them, waiting for 1 crore for 60 days would mean a lot of gap in their working capital, and they would require this money to come in faster. But ITC would have a standard practice of, let's say, saying in for paying in 30 days, 45 days, 60 days, whatever the terms may be. Now, if this money is supposed to come from ITC in 45 days, the vendor can actually take that invoice, come to a platform like Tap Invest, and once the thorough vetting and evaluation of the company as well as the invoice is done, we list that as a deal on the platform where retail investors can come and sort of subscribe to that 1 crore invoice to the tune of whatever they're comfortable with. Minimum ticket size currently stands at 50,000, so any amount starting 50,000 can be invested in. And once the money is invested, essentially the investor becomes owner of that invoice to the extent of money paid. And once the 45-day period is over, and the returns come in or the payment comes in from ITC, this investor will make money. So that 1 crore invoice probably would be discounted at 90 lakhs today. And whatever that 10% margin is, 10% is not what is real. It's usually 1 to 2%. But let's say this 10% margin is something which the investor will make once the 1 crore completely is paid off by ITC. So this is very simply what invoice discounting means. And we help bring these opportunities for retail investors, which until now were not so easily accessible and were limited only to banks and financing institutions like NBFCs.
Okay. So, risk, of course, is like Ankit also said, is difficult for people to evaluate. So maybe we can talk about the risks involved, and what are some of the ways that TAP, like you said, has a vetting process. So what are some of the ways in which you ensure that or whatever vetting it is that you do?
Got it. So we have internally we've set up processes in a way that resemble very closely to how banks and NBFCs would evaluate such a case. So there is a proper credit team, there is an underwriting process. We take the financial data, we take public sources data like GST returns, ITR returns, bank statements, and obviously the financial statements. Do a thorough evaluation basis how financially the company is doing. On top of that, we also evaluate how the management is doing, how the industry is overall performing. Is it a red flag industry or not? And then there are certain softer checks in terms of looking at their performance, traction, operational metrics as well. Once we have a go ahead from our risk committee, basis how the case looks like, then we have the comfort of going ahead. At that stage, we do checks on the invoice, whether this is a legitimate invoice, getting verification done with the customer, and then taking care of operational processes like setting up an escrow where the amount will come in from the customer. There are also physical checks done. So we have tied up with various agencies who actually go visit these companies and make sure that the office actually exists, the residence of the founders actually exist, right? So the physical checks are done. And once all of this is done, then we sort of go ahead and put the deal live on the platform. For additional security layers, we also take eNASH mandates so that if, let's say, the company doesn't pay on time, then eNASH mandate can be triggered and the money can be auto debited. There are also security checks that are collected, which can be bounced in case the company is not paying on time, and then under Section 138 proceedings can be initiated. So these are additional security measures also that we've taken so that the investor money is sort of protected.
And what are some of the risks that investors should be aware about?
See, end of the day, you're investing. It's a credit risk that you're taking in a company, right? So investors should definitely know that the worst case scenario is if the company goes under, then and they don't have any assets to sort of liquidate and pay off the liability, then that's the ultimate risk which investor is taking. But fortunately, so far we have not seen such a scenario. Obviously, there have been a few instances where, because of operational issues, there have been delays of few days, which are compensated for as well. But the ultimate risk is if the company goes under and there are no assets to liquidate, then you tend to lose the investment amount there, which is what we try to protect through the underwriting process that we've set up.
Okay. So, Ankit, who should actually be investing in invoice discounting?
See, if you're a beginner in invoice discounting, first of all, it's important that you have built a decent enough portfolio in mutual fund. Mutual fund generally for a beginner, that is where people should start from. Once that is there, because the risk in invoice discounting is slightly on the higher side, as Mitha was, as Soumya was pointing out, and also there is a liquidity factor that you need to consider. So if you have invested the money today, and if it is say maturing in 45 days, you have to wait for 45 days. If you need the money in between, secondary market doesn't exist as of now. So first of all, building that basic infrastructure or basic foundation for your with your mutual funds is very important. Okay, and post that is likely based on your needs, who have already built this. And if you have if you're looking for something small, short-term investment, this can be an incredible opportunity, because most of the deals mature under 3 months. So if you just want to park some money and make decent returns, not the 3.5% return that you are making. By the way, for 3 months, even if you're putting money in FD, you're not going to make 7%, 6% kind of return. It will be very small, like 3.5%, 4% max. So if you want to make decent return, better returns than 3.5, 3 to 4% kind of number, you can put some money here. and it matures in some time, whatever the maturity period is. Another thing is that if you're looking at for more from longer term perspective, what you can do is like you invest say x amount, say 100 rupees, you invest today, it matures in 3 months, and then you find another deal to invest in. So you're converting these shorter term investments into longer term. Okay, and there is a provision, how we can do that, easily on the platform through reinvesting it. That is how you can convert it even for your long term needs. Okay. So as I mentioned, the liquidity is something that you should be aware of, and risk is also something that your portfolio should be able to take care of.
Okay. So, Soumya, now over to you in terms of deal selection. So, how do you select deals or how do you source them, and what kind of suppliers are typically there on the platform?
So we have a sales team, and they come from this space. So they have worked with various SMEs and companies who um, have been taking working capital loans, business loans, term loans, etc. So there are two channels primarily. There is a direct channel wherein through the network that the sales team has, as well as reach outs, referrals, we sort of generate our own pipeline. And then we also have a partner network. These are basically DSAs who are well connected with the whole SME network, and they know which company is raising capital for what purposes, and they sort of pass on the right deals to us. And once we have these inflow, then we do the initial checks, then detailed checks, and then finally the deals are made live on the platform as following the process as I was describing earlier. But yeah, these are the two primary channels that we mostly use. In terms of the type of companies, so the companies on which the invoices are raised tend to be relatively larger companies. So ITC, as I was saying, and then there are many others like HPCL, IOCL, and the likes. Not all customer companies will be so large. Sometimes these can be SMEs as well, but they would have strong business history and repayment history with the company whose invoices we are discounting. As far as the companies whose invoices we are discounting are concerned, these are mostly SMEs with, let's say, a 5 crore plus turnover. They've been in business for at least 3 years. They would be coming from industries which are in our green flag industry list. And they would be having some credit history in terms of, their CIBIL repayments would be strong and the CMI ranks would be strong. So these are typically the type of companies that we like to bring on board. Most of these tend to be B2B segments, so trading, manufacturing, and nowadays sunrise sectors like renewable energy, your solar, EV, etc. These are some of the sectors that we are heavily focusing on.
Right. So, how would you suggest investors to evaluate whether a deal is good or not?
See, what we from our side do is we provide a detailed information about the company, about their financials, operational metrics, about the management team, and how. So all the parameters that we typically evaluate, we try to provide transparent information about that, and we keep updating this information also on a regular basis. So it's very strongly advisable for investors to definitely go through all of this information and also do a little bit of their own checks, find out about this company through online platforms, Google search, news search, social media, etc., just to build confidence. And it's always good to. So most of the companies that are existing on our platform for some time now, we also provide repayment history with TAP. So how many deals have done, what is the repayment with TAP looking like, etc. So looking at these data points can help investors make a more informed decision. But for somebody who's starting out new, I would suggest that better is to try with smaller amounts, see how it goes, test it out for a month, 2 month, check out how the repayments are looking like. And once you build confidence in the product, and nobody understands investment without putting in the money, right? All theory is of no use until you actually start getting
Yeah,
involved in the
absolutely.
process of investing. So if you
Yeah.
really want to understand the products, try out with a small amount, see how it works, learn about the product, and then grow gradually. That's what I think we've seen working for most users.
Okay. And Soumya, what does your typical user look like?
We have mostly, so as Ankit was also highlighting, right? These are people who are seasoned investors. They have at least 2 to 3 years of investing experience with mutual funds, stocks, or other such asset classes. They understand what fixed income is, what is the value of fixed income in the portfolio, and therefore now they're trying to diversify with newer fixed income options. So these are, given the nature of the product, these are existing investors having some experience and understanding. This is not something which is meant for somebody who's new to investing for sure. They should start out with relatively more safer, better known options. And then yeah, once you're little more seasoned in your journey, then that's when you should pick a product like this.
Okay. So, Ankit, to a person who's already seasoned, right? Like Soumya spoke about, okay, what they need to look at to evaluate a deal. But I think, how do you evaluate your readiness to invest in invoice discounting?
So, Mita, as I was mentioning, that first of all, you need to build that, a portfolio through mutual funds, which gives you a comfort key. If you need some money urgently, that money is there for you. That can be liquidated. You have access to it very easily. That is very important. Second is understanding your own risk profile, giving how much risk you can take, because this is riskier than a lot of other fixed income instruments that most people have been investing in. The fixed deposits and most of the mutual funds, debt mutual funds that they have investing in. Now, if those things are sorted, you can start investing in it. Take a small step. You can start investing in this, and I can't give numbers in terms of allocation here because it is going to be different for everyone. And what is the portfolio size that someone should reach before they can start investing? Because again, that depends from person to person. But once you are there, you can start investing a small portion of your overall debt portfolio. And even when you have started investing in invoice discounting, don't put all your money in just one deal. Okay, just spread it out. Good deals keep coming. Be aware, okay, when deals are coming, you can keep checking, or be connected to people. And once those deals are there, act quickly, invest in those good companies. And as and when they mature, because of course this is gonna mature like relatively quickly, so keep reinvesting. That is how you'll be able to build on it, a decent sized portfolio, wherein not only you're using that invoice discounting as a diversification, but even within invoice discounting you have diversified your portfolio.
Got it. So I'm just curious, right? Like, I think this is a asset class that is new to India, but I don't think it's obviously not a new idea as such. So, how does invoice discounting in particular compare globally versus in India? So that maybe we can also look to seeing, how it has developed in other markets, and maybe you can also talk about some of the other asset classes that you were talking about earlier. This goes to, again, like what we can expect, like as markets mature, like what are the kind of things we can expect here in India.
Got it. See, in India, even globally, so these kind of products for retail have been fairly recent, right? What the only difference between some of the global large economies versus India is debt as a part of people's portfolio is more prominent than what we see in India. And then when I say debt, I'm not counting FDs because FDs is still like very heavily dominating everybody's portfolio in India also. But if you look at some of the other categories like bonds or let's say government securities, T-bills, etc. These are something which normally people in the developed economies very commonly invest in. Even in India, very recently, we are seeing efforts made from regulators. So there's a platform called RBI Direct, which came into being last couple of years, which allows retail investors to directly invest in government securities, T-bills, and so on. So lately, there have been some instances where we are seeing at a macro level some efforts being made to make this more mainstream. Whereas globally, this has already reached a stage where people understand what bonds are, how do you use bonds and these fixed income products in your portfolio, and how do you sort of balance out striving for an alpha as well as trying to protect your wealth at the same time. So um, the only difference is, I think, in India, this wave is just beginning to happen. There's a lot of education awareness exercise that will follow. Some effort is being made by regulators, but I think this, as platforms and people who are sort of originating these type of deals and trying to penetrate this more deeper into the retail market, it's our duty as well to ensure, and definitely platforms like WealthUp, right? As Ankit was also mentioning, that it's our collective responsibility to ensure that we do as much as we can to spread awareness and education about this asset class.
Sorry. So actually, I don't even count FDs and jewelry as investing. For most people, it's a way of wealth preservation almost.
Right, right. It's where people like to just park funds for a long term something that they won't spend otherwise.
So, Ankit, what about you? What kind of things have you observed with your clients? When it comes to in because people are interested in like what's happening around the world. So,
So still a lot of people are fascinated by equity market. Okay, what's happening in US, what's happening in China, and should we get exposure to emerging markets and stuff. US is an all-time favorite again. Should we get exposure or not? um, Still the awareness of fixed deposit is fixed income is like very limited. So the chance that someone will come actually and ask hey, is there a way to put money in fixed income? First of all, what is fixed income? People don't know that. Many times the term fixed income is also something that is not a lot of people are aware of. And because fixed income and fixed deposit goes along the similar direction, it's like how it's the same thing now. Fixed deposit is what fixed income is. I mean, they don't understand that fixed deposit is just one type of fixed income. So talking to people and expecting that they will be reaching out to us or asking us, hey, are there any other options? That is something that it's like you don't know what you don't know, right? So, and that is what we are it's our responsibility to change, as Soumya was also pointing out. And apart from that, the trendiest thing, should I invest in crypto? So, and there are people yeah, so I have I have a diversified portfolio. I have put money in fixed deposit and I have put money in crypto. I'm like, that doesn't make any sense. But equity is too risky. Crypto is fine. Equity is too risky. And investing outside fixed deposit is too risky, but crypto is fine. So those things, like just bringing, explaining it to them what that actually means. When you're diversifying and again explaining risk, which is very difficult. Return is very easy to understand. Yeah, I'm getting 15%, 10%, 20%, whatever the number is. I'm getting this. So people understand that. Risk is not something that people understand. So that is the challenge, that people face. And many times it's also like, but why should I put money in debt? It's giving me lesser return than equity. Okay, so why should I leave fixed deposit? Again, if people don't understand the spectrum of how things move across the the risk spectrum and how the return changes. So that's the key problem there, risk,
yeah.
understanding risk.
No, Soumya mentioned correction that we're facing right now, right? I can tell you, like last year, we kept hearing this, like, why is so much money in debt? Why are we parking so much money in debt? And this is the kind of conversation I could continuously hear from clients, because they were like, can we increase our equity allocation? And, like even for people who are just starting out, like, because we work with a variety of clients. So these are people in their, first job, and we're telling them, okay, you need an emergency fund, but they want to jump into equity. So it's like it's tough. I think at some point we are motivated by greed, and I think we need to just, yes, like you said, Ankit, be mindful of that risk return, that what that entire matrix kind of looks like. So
And
and
you can take
sorry.
risk, right? You need to know when you can take risk. If you have not made that emergency fund, you can't invest in, I mean, even invoice discounting or any other fixed income kind of instruments which have higher risk, because many a times it also comes up with illiquidity. The money will be blocked for some time, and what if you need some money urgently? So I mean, it's a very common conversation that we keep happening, that keeps
I mean,
happening.
let's say if you think about it, there are a lot of misconceptions, right? Like we have people who are contributing to PPF and NPS, and that's it. That's their investment. Again, like these are people who are just starting out, so they think they're investing and this money is growing, but like again, zero liquidity. So I think, yeah, I think liquidity, risk return, diversification, these are some things that people really do need to understand. And I think, but we are getting there. I think with all of the influencers, and I think the entire ecosystem is coming together to educate. And I think, I mean, the US is not where it
I mean,
was like overnight, right? So
what you mentioned about PPF and NPS, it's also about just because it worked for the previous generation,
yeah, that's true.
we
Even
can set.
FDs for that matter, real estate, FD, gold, we understand this.
I'm like, okay, I just started working my first job. I'm like 2 years of experience, 3 years experience, and I've started making some money. But this some money, even if I'm making like 30,000, 40,000, 50,000 per month, for a lot of households, that is a lot of money. That much amount of money was never seen in the previous generation. And then Indians being Indians, it's like कि बच्चे को तो कुछ आता नहीं है ना, मतलब how will he or she manage 50,000 rupees, right? So we need to help. And of course, when parents are guiding, parents can only guide what worked for them, what they knew, right? So FD, PPF, NPS, work, and that is why they are influenced. And the people, because again, people, the younger generation, because they don't know what all options exist, what is good, what is bad. That is why they're like, okay, so parents are there, someone they completely and implicitly trust. So okay,
Yeah.
they must be. And another thing is like, how do you fight with your parents? Can't tell I know better than you, right?
So, I think just to give people credit also, I think there is a lot of information out there, but processing it, understanding how it applies to your situation is such an overwhelming task. It's just like, just tell me what to do. And I think, part of it is also there's too much cognitive overload to trying to figure all of these things out. And with new instruments coming in, it's just more of FOMO inducing rather than actually getting people to take action, is what I feel. Okay, so Ankit, like actually coming to how to invest, right? So, with this partnership with TAP, if you can talk about the partnership and how people can actually get started with investing in invoice discounting, after, of course, they have evaluated if it's right for them and evaluated the deals, all of that.
Sure. So as Swami was pointing out, this is invoice discounting, short-term investments that are there. If someone is interested, they can go on our website, log in, and under transact, they'll be able to transact section. They'll be able to see all the deals that are currently live, on invoice discounting. We are gonna help people, our clients, to evaluate which is, if it is relevant for you or not, and which ones are the good ones that you should be going ahead with. So, but in order for people to explore the options that are out there, I mean, that is just very simple. Just get online, log in on our website, wealthup.me, and after that you'll be able to see it, complete your onboarding, the KYC and sharing the basic details. And once that is done, your account is kind of activated, and you can start doing the transactions. But of course, we'll be
Okay.
there to guide you as and when it is relevant for you.
Okay. And just sort of understanding what is happening, like, or what we need to be excited about next. So any things that are exciting you, Soumya, about either trends that are coming up or technologies that you feel would reshape fixed income, or any other insight into like what to expect.
So, from a space perspective, I think I strongly believe that fixed income is going to become very mainstream. There will be today, I think right now there are limited deals, limited opportunities. People have to really be at the edge of the chair to find out the best deal, and before they can click invest, it's already sold out. So the supply will definitely start increasing with increasing demand for these type of options. There will become a lot of standardized tools to evaluate deals for specifically from a retail standpoint. Lot more information, lot more awareness. It'll become easier for somebody starting out, even new, to access these deals, understand what's happening, get this added into their portfolio much faster. And for example, we work with a lot of other wealth managers and IFAs, right? It's a very new product even for them. It's good that platforms like WealthUp are coming up and they're taking this proactive measure to sort of add on this new investment opportunity, make this accessible and available, and even educate and support and help with decision making. So I think such kind of support never existed before. Sadly, a lot of IFAs are still stuck with mutual funds and they're just selling that because it's easy to understand and there's no effort required. So, good news for investors is that this is going to become even more easily accessible. Um, Education is going to become more mainstream. They'll find and more opportunities to diversify into, and better way to build wealth and diversify rather than just rely on FDs or just crypto, right? So, there's good news is that there's going to be a whole spectrum which was missing until now that will build up, and we'll not have to operate on extremes anymore.
And Ankit, how receptive have people been? Like, have you started talking to your clients about it? How open have they been to exploring this as an option?
So people have started talking about it, asking questions. Ki, okay, so how will it work? How do you evaluate it? So is it, how risky will it be? And so okay, so the money, so illiquidity. Okay, so the money is there. What if I want to take it out and stuff? So that is how you do it. This is how the structure of the instrument is, and so they are curious about these. Of course, it takes some time for them to actually evaluate and start putting money, because some comfort level is needed, right? And that is what we are trying to build. Okay, let's start with a small number, and even for people who are ready from the perspective of their overall portfolio, we are trying to help them. Okay, this is how you can take an action, and how you evaluate, and okay, so my own, what's my own assessment? Okay, if this is a good deal, and whether you should go for this one or not, or wait for another one. How you should go about it.
Yeah, and generally, like I've heard a lot of excitement around bonds. I don't know why, but like even as early as April of last year, a lot of people kept asking me like, how can we invest in bonds? But I think invoice discounting is something that is like very new. Like even like people haven't, it's not become part of conversation yet. And I think like with doing more posts, with doing more content, I think we need to get there where people, like you said, will get more and more curious about it. So I
So
think
correct
happen.
me if I'm wrong, but I think bonds as a term and an instrument is much older than invoice discounting as a product, not how things were functioning, or what businesses or banks were doing it. But I think as a product, as a term, I think bond is much older. So that is another factor, right? Somewhere.
Yeah, so with bonds, what happens is it has been an investment product for a longer period of time. So HNIs, it's a favorite category for HNIs. All banks park their liquidity and manage treasury with bond investment. So as an investment product, it's much older. Invoice discounting has been a credit tool, right? It has been a lending product for all the time that we know. Very recently has it started entering into the investments domain now.
Yeah. So that's another thing. Like, it's just the tenure for how long it has been. That is another reason. And many times, I also, few of our clients, reach out and ask, hey, can we invest in T-bills? Okay. So now that as a term is not really used in India. I mean,
Hmm.
particularly among the retail investors. But just because that is happening in the US, and okay, how US T-bills rate is moving up and down, then can we do that? And of course, Indians still are heavily influenced by the things that are there in the US, and bonds have existed for a long time in the US. So that is another factor.
Yeah.
I mean, bonds as a term we learn in school, right? Like, so I mean, shares and bonds is something we are just familiar, like to hear. But surprisingly, like P2P really took off, right? I mean, now, of course, it's we don't know what's going to happen with it. But I mean, P2P is just suddenly there was like this boom and like, everybody was talking about it. So, maybe that, hopefully will happen with invoice discounting as well.
Yeah.
So last question for the call. Soumya, what is next for? Sorry.
For P2P now, I read somewhere on, I think on LinkedIn only, a lot of the companies, they don't have a product problem, they have a marketing problem. And I think P2P was marketed very well.
Hmm.
It wasn't that great of a product, and there is a reason why SEBI is taking the action it is taking. But the marketing of it was done very well. So
And even distribution. So all the IFAs were selling mutual fund and P2P of all the things.
yeah,
Distribution was cracked well.
yeah.
But that's the thing, right? Like I think it's how you package it, how you sell it, because again it's like that whole crypto thing, like putting your money in FD and crypto. So yeah, so I was saying, Soumya, last question for you: what is next with TAP? Like, what are some things that investors can be looking forward to, be excited about?
So, see, our goal with TAP is to become a home for fixed income for retail investors. And that means that not just invoice discounting, we want to increase access to all sorts of fixed income products that we spoke about and actually bring and bridge that spectrum which is currently missing. Invoice discounting is easy because it's a short tenure product. It's the trials are much easier. The cost of trial is much lower. So that's the product we started with, but the plan is to bring a whole plethora of many other options, make it available for retail investors, and obviously as and when they come in, we will definitely keep WealthUp also informed, and we'll see how we can make it available on WealthUp platform as well. So that is one exciting thing which is definitely coming up. Another exciting thing that we are currently dabbling with is how to make bond investing easy for retail investors. And we're not trying to solve for the investment problem per se, because I think for that there are already a bunch of platforms that are doing it. But then there are a lot of fundamental problems that exist, the likes of not knowing enough about bonds. How does taxation work? How do you track once you make the investment, and such fundamental problems, right? Which again takes me back to my favorite sentence is bond. The whole fixed income market today is where equities was 10, 15 years ago. So just everywhere there are so many problems to solve that there's a very big opportunity area. And good thing is people are now recognizing the need for it. They're understanding the need for diversification. They're coming and listening to platforms like Tap or WealthUp, that something like this should be taken seriously, and they're putting in the effort to understand and try it out. So we will do our bit in ensuring that this only becomes easier and more streamlined for retail investors, and we're open to feedback. Happy to hear what your users want, and we keep listening to our users, and we'll keep improvising based on that.
Yeah, I see a lot of your LinkedIn posts asking for feedback and sharing, like build in public kind of, like being very open to hearing what people have to say. And I mean, as founders, like that is the best kind of way to build something, right? Like to hear, iterate quickly, get like ship it out.
Yes.
So, and Ankit, what about WealthUp? What is happening next? What should investors be excited about?
Tap and invoice discounting was our first integration on the platform. We are working on for quite some time now to get mutual funds on our platform. Hopefully, that will be live soon. And after that, we are also working on bringing a few more financial products, and again trying to bring the benefits of these products and the entire spectrum, so that anything that is associated with your personal finance can be catered to from this one platform. And so that is the focus right now, bringing in the benefits. We are not super focused on the entire the platform and the in terms of the experience and how the UI UX and all are. That's not the focus right now. Once we have bring in sufficient number of products on the platform, that is when we'll start working more on the product side. Okay, how is it that we can improve the experience, the delivery point? So as of now, we are just on website, right? I mean, the web, not on mobile apps. So once we have figured these things out, that is after which we'll also get into how is it that we can improve the experience, that delivery point, and just making things more and more convenient for people to have access to everything and all the transaction that they want to do, the information that they need, just making it super easy for them.
Yeah, and Soumya, the credit goes to you, right? Like in your team, because you were so quick. Like we had a LinkedIn live a couple of months back, and like it happened so quickly, and we were able to integrate and get started. And that's always amazing for us because we've been trying to integrate and bring these products in one place. But like it's all about moving quickly and getting it done. So I think kudos to you and your team for making that happen.
So yeah, and that
Yeah, no,
too, we need to remember, all the holidays that were there in between.
Yeah,
Even
it was all
that,
for the holiday season.
yeah,
No, I think
yeah.
it's likewise, right? So your team also was pretty prompt, and I think both sides, people were just excited to get this going. It's our first integration also, although we've been also engaging with many other platforms where it's about who moves fast and then prioritizing it and just getting it done, right? So I think, yeah, kudos to both of us on that note. But yeah, it's just shows how committed we are to making this happen for retail investors, right? And we are there for whatever people need.
yeah.
Yeah. Awesome. So thank you so much, Soumya, for once again, being here and sharing your insights on this topic. And thanks, Ankit. We will keep doing this. Once in a while, you'll see us pop up on LinkedIn. So thanks again so much. Thanks everyone for who is watching and for everyone who's going to watch the recording later because most people end up watching the recording. So thank you, and yeah, hopefully more exciting things will come. So do follow Soumya and Ankit. They're both extremely active on LinkedIn. They do share a lot about what's happening in this space. So if you are genuinely interested and curious, chat, DM them, or follow them. So yeah, thank you guys, and have a great night.
Thanks, Soumya. Thanks, Medha.
So much.
Thank you, everyone.